Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market, from global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fitch Ratings Fixed Interests podcast. My name is Justin Patrie. Today we're going to talk about AI and tech disruption and what it might mean for structured finance risk and asset performance. And for this discussion, I'm very pleased to be joined by Suzanne Albers, a senior director in our structured finance team. She is also the lead author of the recently published report, Technology Disruption Risk Accelerates for ABS and MBS. Welcome, Suzanne. To start off, Suzanne, why did you write this report now, and what has gotten to the point where you wanted to analyze and look at some of the big picture tech trends and their effects on structured finance?
Thanks, Justin. We know that there's a lot of focus already on the potential impact of disruptive AI, on bubble risks, and which is right. We think that's a good place for there to be a focus on. But the reason we were interested in writing this report is we didn't think this was the only technology story that is relevant for ABS, CMBS, and RMBS. So we took this opportunity to both highlight some lesser known technology risk areas and also to take a look at those and the better known cases, but really what's their specific obsolescence risk and impact that could relate asset values that are relevant for these structured finance sectors.
So what are some of the principal tech disruption themes that could be most impactful for structured finance?
So in this report, we focused on auto ABS as well as commercial and residential mortgage-backed securities. And the reason for that is that these are the structured finance sectors exposed to automobiles and property, because this is the security for the loans in our asset pools. So these values over time are important for the performance of ABS and MBS. Then, knowing that this is what we were looking at, we split our assessment of risk of overvaluation from obsolescence into high, moderate, and low risk categories. For example, high risk relates to a high risk of asset bubble formation or significant risk of large cuts to asset values, even in cases where there isn't a bubble in place. So under high risk, we highlighted two different areas, which are actually quite different. One related to automobiles facing a combination of disruptive technologies. So this can occur, let's take an example. So we take an example of an older electric vehicle that already has a limited range from its older battery. And then let's say it's now facing a new challenge, which is unsupported software. This can arise also from different areas, for example, due to a manufacturer default, or because there's actually problems updating the software. This could be, for example, due to 2G and 3D shutdowns across Europe. So the combination of these is something that we think could significantly worsen the resale values for these types of cars. We also noted under high risk, one possible AI impact scenario. This is one which is a high impact because AI replaces many jobs without creating similar ones. This leads to pressure on demand for office property, housing, particularly in commuter areas, and also lower demand for expensive purchases such as cars. We published this report on the 3rd of February, which was also when US tech stocks fell sharply following the Anthropic announcement about new productivity tools. February was a month that saw investors taking this type of AI impact scenario very seriously, especially for software companies, but really also for companies in other sectors, such as legal and services. So this is a form of technology disruption that could have far-reaching impacts, including for asset values in ABS and MBS.
Can we drill down into one of the sectors you focus on in the report, specifically commercial property and financing? Because this is one area where obsolescence risk was higher than some of the other sectors.
Sure. So the high-risk scenario or option we mentioned was the one I already discussed, which is regarding the AI scenario, which we highlighted for both commercial real estate and residential property. But we also raised several moderate risk areas for commercial property. and these relate to data centers and logistics. So focusing on data centers right now, firstly, because this is, again, another hot topic. There's a lot of interest in data centers. There's a lot of investment in data centers in light of current and expected AI usage. And in the sector, we see the potential for technology to really differentiate the sector. So the data centers that are able to take on board and use the new technologies that will really emerge as the cutting edge standard for data centers, those are the ones that are going to differentiate themselves. While legacy facilities, which are missing all of these features, some of these features, are more likely to face obsolescence risk. And then there are even existing data centers that could become stranded if they cannot secure some even more core upgrades, so grid upgrades and cooling solutions, which again could lead to even more differentiation within the sector. We also noted that data centers is an area that, let's say, isn't just limited to data centers, and I'll explain that a bit more. So when we look at all the resources that are going into the construction of new data centers and upgrades of existing data centers, we see that that's already causing bottlenecks for supply chains, bottlenecks for contractors, and leading to higher costs, leading to higher power prices and construction costs. And this is something that will not just affect data centers, but will be felt in a much broader set of areas, including other types of commercial property.
So far, we've focused perhaps a bit more on the negative risks, but what are some of the tech evolution themes that could improve underlying asset values for structured finance transactions?
Yes, we do tend to focus on the downside risks. That was what we were trying to highlight in this report. But in many of these cases, the risks also have a opportunity side. So there are cases where there can be positive impacts for the companies and the property owners that are able to best use these new technologies. So we also highlight areas where new technologies can support asset values. And examples for these include autonomous driving capabilities for cars. So this is the more advanced end of advanced driver assistance systems, which are often popular with drivers. Also, there's logistic providers was something we highlighted on the commercial property side. And this is a case where, again, the providers that are able to take advantage of new technologies such as mobile robots, automated storage and retrieval systems, AI-led management systems, those are going to have an advantage. And finally, for homes, more efficient heating and energy systems are something that we think can make certain properties more attractive. Then, and one more point we noted was regarding, again, on the automobile side, scalable electric vehicle platforms and centralized reusable software architecture. So we highlighted the downside risk, which is that if a problem arises, it could affect a larger number of cars. But really, this is also can be a positive, and that this sort of technological advancement can help facilitate rapid development across models and segments. And this, we think, can keep costs down for a larger number of vehicles.
Finally, what are the core tech developments that you are watching out for over the next 12 to 18 months that could matter most for structured finance that perhaps we haven't discussed so far?
Yes, one other area that I'd like to mention that we are currently exploring a way to consider more directly in our rating analysis is physical climate risk. And we published a report on this last year called Structured Finance Physical Climate Risk Discussion Paper. And I bring that up because it's maybe not the most obvious connection to technology disruption, but we did highlight different ways we thought it could be relevant for asset values. So one area is that technology could be used to protect properties from natural disasters. Another area is that, particularly on the commercial side, buildings could find ways to prepare and give more data to insurers. So there's a better link between or better understanding of the risk for that particular building. And we think these are technological developments that could lead to lower insurance premiums for the properties that are able to use this technology. But at the same time, we keep on pointing out the flip side, which is that properties that are unable to do this could face higher insurance premiums and or reduced coverage. On the buyer side, we are already seeing AI being used by many home purchasers as part of their decision process. And really, we expect this trend to continue. We think AI could be a great source for more localized information. So that could be climate risk information, for example, or that could be neighborhood trend data, meaning that buyers will just have much more information that they can consider when deciding to buy one property over another. And then again, AI can be used to help synthesize that information, to help them come to conclusions. So, and from this, some areas are likely to come out positively, while others more negatively.
Thank you very much, Suzanne, for spending time with Fixed Interest today. And thank you all for joining us as well. Make sure to check out more episodes like this on Spotify, Apple, and FitchRatings.com. We'll see you at the next one.
Subscribe to Fixed Interests wherever you get your podcasts.